Welcome again to this 13-part series on navigating the difficult world of alternative finance. My name is Kevin Pierce. I'm the President and CEO of Caldez Financial. You can visit me on the web at www.caldezfinancial.com. Today we are joined by my good friend Clif Moshnick. We have been colleagues for years. We worked for nearly a decade together at Wells Fargo Business Credit, which is now called Wells Fargo Capital Finance. And although Wells Fargo has changed a little bit and it's become more of a corporate finance entity and does more, larger market deals, Clif and I worked many years together on smaller, more hardcore ABL deals. And Clif is one of the great experts on inventory finance. I brought him in and thank you, Clif, for being here. I brought Clif in because he's one of the most knowledgeable people about dealing with inventory finance, and to his testament, I think he's been in this business for 25 years and still has yet to record his first credit loss. So that's a record worth being proud of. Thank you, Clif, for being here. I appreciate it. Let's just start at the beginning. Yesterday we were talking a little bit about with Robin Barrett about accounts receivable, financing, factoring, and ABL, but we really didn't put it into an overall context of how a borrowing base really works, and especially when you add another element, which is inventory. Maybe you can speak to just kind of how you see the borrowing base working, and kind of how just the overall thing works in an asset-based lending environment.
Sure. First of all, Kevin, thanks for having me. I appreciate it. We've worked together for a long time. As you've mentioned, and I really look forward to giving you guys some abilities here and thoughts when it comes to asset-based lending. Yep. We talk about hardcore. I don't look at it necessarily as hardcore. I look at it as just trying to be able to explain, the business to the bankers such that they can get comfortable lending against those assets that you may have. Mm-hmm. As you mentioned, over the 25 years. Haven't had a credit loss, so how hardcore can that be? I think sometimes half of it's just helping the lender understand what it is, the collateral that supports the loan, such that they can get comfortable lending against it. Right. So I think the starting point for all lenders is really the borrowing base. Okay, when you talked about the receivables side of things, that is probably the easiest item in which to lend against because it's the item that is most close to cash. So a receivable gets billed 30 to 45 days. From then, it is ultimately collected and you have cash. Inventory is perceived to get a little trickier because it's one step further back in that process. And depending upon the type of inventory and the mix that you need in order to meet the demand, it may take anywhere from 30, 60, in some cases 180 days to ultimately convert to cash. So ultimately, I look at the inventory as being just another component like the receivables. But then kind of peeling back the onion a little bit to kind of better understand what characteristics of the inventories would the lenders get comfortable such that we're lending on what I would perceive as the more liquid items.
Right. Okay, so let's talk about the borrowing base for a little bit. So you have receivables, you've got inventory in the borrowing base, and let's just say that you're getting 85 cents on the dollar on eligible receivables, and you're getting 50 cents on the dollar on eligible inventory. So let's just say that the borrowing base is this big, okay, and then the amount that is being borrowed today is this big. That excess piece is called excess availability, and that's basically how asset-based lending customers measure their liquidity. This is how much I have. Maybe out of a $10 million borrowing base, you may have $2 million of excess availability. So that $2 million can be used to buy more inventory. It might be, to make payroll or whatever. But let's just talk about it in the context is, if you had $2 million and you needed to buy $500,000 of inventory, walk us through how that cash cycle works from the day that you draw on the line to buy that next tranche of inventory.
Okay, yeah. First of all, just for the readers, when Kevin talks about excess availability, he's really talking about the borrowing base that's available less the loan that's outstanding. So that's the excess availability is that portion of the borrowing base that has not been drawn. Right. So in your instance, somebody wants to go out and buy $500,000 more in inventory. Day one, once the cash goes out the door, the inventory, let's say, comes in immediately, that will then create additional availability. So if we're lending 50 cents on the dollar, like you said, immediately with that payment, your borrowing base would go up by $250,000, assuming you've had received the inventory.
Right.
So now, then the next step is we kind of, as an asset-based lender, we roll forward that borrowing base on, various frequencies. More for lower market ABL type deals, it's more of a either daily or weekly term. So the thought process behind it is this: as the borrower creates more collateral through that acquisition, of the inventory, which ultimately gets converted into a receivable and then collected. As those changes take place within the borrowing base, it's reflected in your reporting to the bank.
Right.
And that those types of events create then more availability. And in your case, the availability is created with the inventory. When you sell it from the inventory to the receivables, you get a higher percentage advance rate, right? So if you go from 50% on the inventory and now you're selling it to creating a sale and accounts receivable, you're getting 85% on those accounts receivable. So your borrowing base will increase. So in your next report, it will increase. When the cash comes in, it pays down the line. That receivable is no longer there. But at that point in time, you're buying more inventory. So it's kind of like a continuous cycle. ABL is kind of like always refreshing the borrowing base such that it's reflective of your current current collateral position.
Right. Yeah, and that's interesting because, and I explain ABL in the context of people who understand real estate lending. When you lend against real estate, your collateral is the same. And next week, if you do a new appraisal line, it's probably going to be about the same. But in the case of these dynamic companies that are always buying inventory, always converting it to a receivable, the composition of your collateral is completely different on a day-to-day basis, which is why, to your point, a lot of companies that are tight on their availability may want daily reporting or weekly reporting to kind of keep up with all this. And margins play a key role in this too, because you mentioned that if you convert $250,000 of the inventory availability into a receivable availability, if your cost on that inventory is, say, $1 a unit, and you're selling it for $2 a unit, then you're basically borrowing 50 cents a unit, but then you're getting $1.70 a unit, right? So,
exactly.
So it really really has an impact if you have big margins in that business.
Margins are huge. And the other thing is if your business is growing, I think you want ABL because you want that borrowing base to reset more frequently than once a month, because that if a bank is only requiring monthly reporting, that restricts your ability, your borrowing base, and companies that are growing.
Yeah, so these are all really great points. And let's focus in a little bit on the inventory reporting aspects, because you just mentioned that. So what are the reporting requirements typical in a what I would call a traditional asset-based lending arrangement?
Typically we're going to look at weekly reporting is what you'll standardly see. If things deteriorate, it might be a little bit more frequently. You're definitely going to get a collateral audit because you want to make sure that the lender is comfortable with the inventories that being reported. So they're going to look for things that are ineligible and as such. And periodically they'll order an appraisal. The appraisal kind of helps the lender better understand, if things were to go south today, what they could expect to realize on that collateral in a liquidation scenario, because there are costs and expenses associated with that.
Right, and so the appraisal that you're talking about, this is the same kind of appraisal you would do before you even close the loan. Mm-hmm. So periodically, maybe once every year and a half or something, you may go in. What are you looking for as a lender? What is the number that you're looking for that's contained in that appraisal? What helps you?
What I'm looking at is I'm looking at the characteristics of the inventory. I'm looking at what they expect to recognize in the event that there's a liquidation.
So like a net orderly
yes.
value? Okay.
We typically start at like an 85% of a net orderly liquidation value is what we typically lend on. Mm-hmm. Those values improve or decline based upon really the gross profit margin of the sale of those inventories, kind of like what you mentioned before. Inventories that have a higher margin are going to typically have a higher liquidation percentage than something that is a little bit that lower margin business.
Okay, and so every week when I'm reporting my rollover of sales and credits and all that kind of stuff, do a lot of, my experience is that the non-bank lenders typically require another inventory report. Some lenders maybe don't. I think at Wells Fargo, we reported inventory monthly, and those ineligibles were static throughout the month. But that's not always the case, right? And when you get out of the banking channels, they'll be more frequently reporting. How do you think that impacts a borrower? Is that to their advantage, to their disadvantage? What do you think?
I think as an asset-based lender and as a borrower, I think that the more frequent that you report, I feel it's better, because you know where you are at all times. It's going to avoid kind of some of the bigger misses. Sometimes when you have that monthly reporting, you find yourself maybe with that borrowing base reset being less than what you had anticipated. So I kind of like the more frequent reporting for sure.
Right. So what kind of companies, I think we all think about manufacturing, right, being sort of a mainstay in the asset-based lending world where collateral is king. What other types of situations do you see come up where inventory is an important component?
Well, definitely the biggest one's the distributors right now, and especially in our marketplace in the southwestern United States. We've got a lot of importers and distributors of various products. So I think that's primarily sort of the bread and butter of my portfolio. We have some food and beverage type of companies, but again, they either do a slight amount of improvement or just distribution of food and beverage. So I think that's primarily the biggest component there.
Well, that's great. So we're talking about inventory here, and when you talk about AR, you talk about, let's say if a company has $1 million or $10 million of AR or whatever, they're not 100% going to be eligible in most cases. There's going to be some older AR, there's going to be some AR that, for what, maybe if it's a related party. So not all AR that's showing on the accounts receivable aging is going to be eligible. Obviously the same thing is true. So can you walk us through some of the collateral that a company might assume would be eligible for borrowing, but maybe not from a lender's perspective?
Well, I mean, the obvious one is slow moving. Slow moving depends based upon the industry and the lenders in which you're doing business with. A good rule of thumb is anything over a year. So, if you can't sell that inventory in a year, in a liquidation, that inventory is not going to sell unless it's significantly discounted. So that's primarily the largest one. When you look at packaging, when you look at various supplies, when you look at locations that are like less than 10% of the total inventory, or maybe $100,000. Those items would be considered ineligible because they're difficult to go ahead and track down and get access to in a liquidation.
Right.
My favorite one, honestly, is anything that's alive. My boss told me 25 years ago, we don't lend on anything that eats while you're sleeping. So we definitely nothing alive. So
right. No chickens. No. Well, this is going to be an important place. Agricultural businesses, obviously, they have you typically morphed into food processing businesses themselves. Mm-hmm. So the farm inventory may not be as desirable for a lender, but once it's picked and plucked and processed and getting ready for a sale as a finished product, being boxed up and stuff like that, then at that point it might be more desirable inventory.
The key word is boxed up versus it's still needing to be picked.
Right. Well, it has been an extreme pleasure being here with you for this time. I really appreciate your expertise and your guidance. For our viewers, I hope you've enjoyed Clif's perspective on asset-based and inventory lending in particular. And for you viewers that have been watching this, we appreciate your attendance. Thank you. Certainly always appreciate your feedback. You can reach me at kevin.pierce@caldesfinancial.com or visit me on the web at www.caldesfinancial. Certainly would appreciate any feedback that you've got on this episode. And until we meet again, good luck in your quest for the next tranche of financing, and we'll see you next time.